Hey everybody, welcome back to Actual Investing. Today I want to talk about a company called Snowflake that is currently trading right near its IPO price. Now, if you look at a performance chart of Snowflake, the earliest price that you can see Snowflake at least on Google Finance, is $240 a share, and it's currently at about $133 a share. So why am I saying it's near the IPO price? Well, Snowflake's IPO was actually set at $120 a share, but it soared to $275 a share within minutes of trading. And I think that says a lot about the market back in 2020 when Snowflake had their IPO. The market was just overly euphoric on any kind of growth stock, especially a growth stock with a massive TAM of hundreds of billions of dollars like Snowflake was talking about. So the reason I want to talk about Snowflake today in particular is that when I looked at my watch list today, I noticed that at the top of the watch list were all these software stocks, things like Palo Alto Networks, Salesforce, Palantir, Adobe, Snowflake, Datadog, Cloudflare, Intuit, ServiceNow, CrowdStrike. These are software stocks that, for the most part, benefit from advances in AI. At the bottom of my watch list are hardware companies like NVIDIA, which are down today, along with other semiconductor stocks like Micron, which just reported earnings. Broadcom, also an AI high flyer, is also down. So I'm starting to wonder if this is the start of a broad-based rotation out of hardware, which has done very well this year, and into software, which has not done quite so well this year. If we think about companies like Salesforce and Snowflake, they're actually significantly down for the year, whereas AI hardware companies have been doing really, really well. So that's why I think Snowflake may present a nice buying opportunity on this dip. So let's look at what Snowflake does. Snowflake is a data cloud company. At their heart, they're a big data company, and they enable data storage, processing, and data analytics that are faster, easier to use, and more flexible than traditional data companies. So the Snowflake data platform is not built on any other database technology or big data software. Instead, they have a completely new SQL query engine with an innovative architecture natively designed for the cloud. I just read this off of Snowflake's website. If you're not a software developer, or if you're not familiar with some of these terms, I'll go into what Snowflake does on a more simple scale. I think one way to find out what a company does, if you're not really familiar with the industry, is to look at what types of ETFs the company is in. So this is a website called ETF.com, and it's showing these ETFs that have the highest allocation to Snowflake stock. This percentage here shows the allocation to the ETF. So we see ETFs such as the ProShares Big Data Refiners and the TrueShares Technology, AI, and Deep Learning ETF. So this tells me that this is a big data stock, and it's also a machine learning stock. If we look at Snowflake's recent investor deck, we can see that that's pretty much exactly what they do. So their value proposition is that they offer one platform that can power multiple workloads, and most of these workloads do have to do with AI and big data. Workloads like machine learning, cloud-based applications, and data engineering. And they also offer data warehousing, database, and data lake services. A data lake, for those unaware, is just something that can store and process large amounts of data. So if you think about data as a drop of water, the data lake is a whole bunch of drops of water in one place that creates a whole new thing. At the financial planning firm where I used to work, we actually used Snowflake for our database solutions because we had a lot of data on our different investment products, as well as our different advisor clients that we needed to aggregate and make sense of. So we used Snowflake for data warehousing and data analytics, and it worked really well for us. We were very happy with Snowflake. So let's talk a bit about their business. I don't typically love companies that grow by acquisition. However, Snowflake seems to be making a lot of strategic acquisitions that actually make a lot of sense for their business. One recent one that I want to highlight is Nevo, which is a generative AI-based search tool. So when you have these big data lakes filled with tons of data, it makes sense to be able to search them easily and quickly. It's going to be really tough to make sense of lots of data if you can't even find the data that you're looking for. We can see that they've also made some other acquisitions, such as a privacy platform, data science library, and machine learning and large language model observability. So that's cool that they're getting into large language model services. They also have this application from a couple years ago called Applica, which is a large language model-based document understanding company. One other cool thing that Snowflake is doing is this platform called Snowpark, which has seen rapid adoption lately and just shows no signs of slowing down. Look at this perfectly straight line here. Essentially, Snowpark is a set of libraries that run Python and other types of programming languages next to your data, and that can be used for machine learning and data engineering. This is really, really helpful for companies that are trying to make sense of machine data. And I think it makes Snowflake a formidable competitor to a company like Datadog that analyzes machine data as well. So let's take a look at Snowflake's financials. Snowflake is a growth company, and they are growing quite rapidly still, even while a lot of other SaaS companies have started to slow down. And sure, Snowflake has slowed down, but their growth, at least in this past quarter, was still 33% year over year. I also like that on Snowflake's investor relations page, they give their NRR, or net retention rate, which is still really solid at 128%. So all that means is that every year, even without capturing any new customers, they're able to upsell their customers and get them to spend 28% more each year on their platform. So that's great. I think one reason for this is that Snowflake offers a consumption model for their services, as opposed to a straight subscription model. So a consumption-based model is essentially usage-based. So the more that people use the Snowflake platform and the more data that they store, the more Snowflake can charge them. And that makes sense because if people want to try it out and only use it a little bit at first, they're not going to pay as much. But the more that they realize that it's working for them and is helping, the more they're going to use it and the more they're going to be able to pay Snowflake. So I think that's one of the reasons they've been able to keep their NRR so high. Snowflake boasts that usage-based pricing strengthens their dynamic in ways that other pricing models can't. Yeah, it's also just a way for them to get more money. So that was the bull case. Let's talk about the bear case for a bit, because the bear case is always important, especially if it's a company that you're thinking about buying. So we talked about how they had about 33% revenue growth in this past quarter. Well, next quarter, they're looking at revenue growth of just 26 to 27% year over year. So that is quite a rapid deceleration. Let's take a look at the full year. Full year revenue growth is pointing to 24%. Last year, they grew at 36% year over year. Of course, you can't keep growing at the same rate forever. At a certain point, it's going to be much more difficult to continue to grow because you have more revenue, and it's really hard to grow a big revenue number when it's a lot easier to grow a smaller revenue number. So it makes sense that their growth is slowing down, but is a slowdown from 36% to 24% something to worry about? Maybe, especially when you look at what Snowflake is paying out in stock-based compensation. So essentially, stock-based compensation is giving Snowflake's high-level employees ownership in the company by giving them shares, which are typically created out of thin air, and it kind of dilutes current shareholders because as you make more shares, the shares that are already outstanding become a smaller and smaller percentage of the overall company. So typically this is not a good thing. And when we look at stock-based compensation for the past quarter, we can see that it was $332 million in the past quarter. That's quite significant considering that Snowflake in revenue made $830 million. So we're looking at about a third of their revenue is given away in stock-based compensation. Heading over to macro trends kind of paints the picture of what's going on at Snowflake. We can see that over time since their IPO, their shares outstanding have been steadily increasing. And normally things steadily increasing would be a good thing, but in this case, it's very bad. We want shares outstanding to be going down. And hopefully at a certain point, Snowflake will be able to increase their cash flows and turn a profit, and then they can start buying back shares, which is actually going to help out the shareholders that they've diluted all this time. The thought process of giving away so much in stock-based compensation now is that it rewards their employees and helps to fuel that growth. We also can't ignore this bad news that's been still ongoing about a data breach that's impacted significant numbers of Snowflake customers. So essentially what happened was that some Snowflake customers were not enabling two-factor authentication on their platform. Two-factor authentication is a really important security measure that just makes it so that when someone is trying to log into a platform, they need to log in with more than just a password. They also need to maybe accept a code on an app like Symantec or Twilio. Now, a lot of these customers were not using this, and that's what caused their data to be breached on Snowflake's platform. Snowflake noted in a recent release that several of their customers had their data leaked, but all of these customers did have two-factor authentication turned off. So, to me, this looks like more of an issue with Snowflake's customers being careless than it is a Snowflake issue. However, Snowflake did come under fire because it was their platform that the data breach happened on. To solve this, Snowflake is now setting two-factor authentication to be enabled by default, so customers that don't do anything will have it automatically enabled, which I think is really going to help going forward, and I don't see this being a major reason to avoid Snowflake. I think it's an unfortunate thing that happened, but I certainly wouldn't place the blame on Snowflake solely. I think it's more their customers' issues. Another bit of negative news is that their profitability isn't necessarily improving. This is a release from Morningstar. They're saying that in Snowflake's recent earnings report, their GAAP operating margin is only supposed to be 3% for the full year, compared to their previous outlook of 6% and their actual results of 8% last year. So operating margins are not trending in the right direction, which points to potentially a bit of a profitability issue. Typically, I'm not too focused on profitability when a company is growing so significantly at expected to be 24% year over year. When a company is growing that quickly, they're really focused on just capturing market share, and profitability is something that probably won't happen until growth starts to slow down. So for me, I think this is something to keep an eye on, but I'm also not terribly worried about it right off the bat. What I'm more worried about is their free cash flow, because as Warren Buffett says, cash is king. So when we look at Snowflake's free cash flow, they were burning cash, and now their free cash flow is slowly accelerating each quarter that goes by. So even though they're not profitable on a net income basis, they are generating cash. And the reason that can happen is because of that stock-based compensation we talked about earlier. Stock-based compensation is technically an expense, but it's not a cash expense. So Snowflake is actually making cash these days, even though they're not technically profitable. I hope that makes sense. So now that we've looked at the bull and bear case for Snowflake, let's take a look at my spreadsheet where I analyze growth stocks and rate them on 4 factors, including gross margins, annualized revenue, price to annualized sales, and year-over-year revenue growth. Snowflake on my spreadsheet gets a score of 13.6, and my average score is 12. The highest possible is 20, which I've never seen. So Snowflake actually does score very well. If we look at my entire spreadsheet, Snowflake is actually the 9th highest rated stock on my spreadsheet. Now, this isn't quite a full picture because it really only rates on metrics like growth and valuation and doesn't really take profitability into consideration. So if I did also consider profitability, we'd probably have to ding them a few points. Also, we know that growth is going to slow down. So if I change this number to 24%, we can see that Snowflake's rating drops from 13.6 to just 12.9. However, this still is above my average. So what's helping Snowflake out? Well, they do make tons of revenue. They have annualized revenue of over $3 billion with a solid 77% gross margin. I really like to see high gross margins, and software companies like Snowflake are known for their high gross margins. Also, their valuation is at a historical low. Like I said, when they IPO'd, they had a price to annualized sales in the hundreds. Right now, their price to annualized sales is just 13.4, which sure would be high for most companies, but software companies do tend to have high price to annualized sales. If we look at companies like Adobe, 11.5, Palo Alto, 13.8, ServiceNow, 15.2. So Snowflake's price to annualized sales of 13.4 actually makes a lot of sense, especially when you consider that they're growing a lot faster than those other companies that I mentioned. So what you've all been waiting for, is Snowflake stock a buy today? In my opinion, it is. Now, don't go out and buy a stock just because some guy on the internet said it's a buy. You have to do your own research and look into the stock for yourself. This is just what I'm doing with my portfolio. I do own Snowflake, and I have been buying additional Snowflake shares while the price is down. I think Snowflake has a bright future, and I think even though they are showing some profitability issues right now, and they do have some rampant stock-based compensation that I don't love to see, I do think that those kind of things will be improved upon in the future. And looking forward, I see a company that's going to be able to continue to grow for quite some time. And then when they're done growing, should be able to use some of this juicy 77% gross margin and turn it into an actual profit, not just a free cash flow profit. What do you guys think of Snowflake? Please leave me a comment down below if you like Snowflake, dislike Snowflake, are neutral on it. And let me know if there's any other stock that you'd like me to cover in the future. I'm always loving to hear from you guys to see what you think. And if you're new to the channel, please subscribe. I make stock deep dives. So if that's something that you like to see, definitely join me along for the ride. If you liked the video, please like it. And if you disliked the video, please dislike it and tell me how I can improve. I love constructive criticism. Thank you guys so much for watching the video today, and I hope you all have an awesome day.